Hi everyone, welcome to today's webinar titled Funding India's Deficit, Does the Modern Monetary Theory, MMT, Offer a Solution? I would like to take a moment to welcome all the audience who has dialed in remotely from across the world. Thank you. We hope this is a good session and you find it useful. I'm Ravi. I'm the co-founder of Samasthiti Advisors, and I will be moderating today's discussion. So before I introduce the speaker and get on with the show, I have a few housekeeping announcements to make. Won't take much time. Today's webinar is scheduled for 1.5 hours, including the Q&A. We will have each speaker, both Dr. Mosler and Dr. Van, speak about 15 minutes in the opening session, followed by about 20 to 30 minutes of discussion. And post that, we will open the Q&A. So we have good time for the Q&A, so hope you'll stick till the end. Please feel free to submit your questions throughout the presentation. You don't need to wait till the Q&A. You can do this by clicking at the bottom of your screen on the Q&A tab and typing out your questions. And we'll keep a tab on each of the questions that you post. We value your feedback. It helps us to improve. So please, before you signing off, do take the evaluation survey to let us know your feedback on today's session. So with that, it is my pleasure to introduce our two speakers for today's webinar. They are very famous personalities, so I'm not going to waste time reading out their detailed bios. That'll save us time for the discussion as well. So we have Dr. Mosler, who is the co-developer of the modern monetary theory. I think it is sufficient introduction to say that Warren is synonymous with MMT, which is a short form for the modern monetary theory. He has spent several years in the financial markets, particularly the bond market, in multiple hats. As a trader, investor, fund manager, he has also designed and produced sports cars, which are some of the fastest in the world. And maybe towards the end of the session, we can ask him to speak a few lines about that. And at the CFA Society India, when we thought about doing a topic on MMT, we thought, okay, why not invite the developer of the theory itself? And we are very glad to have Dr. Mosler with us. We also have with us Dr. V. Anantha Nageswaran. Again, needs no introduction. He's a member at the Prime Minister's Economic Advisory Council. Dr. Van, as he is respectfully called, he has spent several years at large multinational banks across different locations in the world. In his subsequent career in academia, he was earlier the dean of IFMR Graduate School of Business. He's a member of the board of directors of several reputable companies in India. And we're really glad to have him talk to us about his views on the modern monetary theory, as well as what he thinks about its applicability in India. Both our speakers have authored and co-authored several books, and I encourage you to look them up post this webinar. Now, before I call upon the speakers for their talk, we'll give you a brief background to the topic as well as the context. As we are all really aware, the COVID-19 pandemic, it is a global tragedy of a very large proportion, and most governments across the world are struggling to grapple with the economic costs of this pandemic. There is significant human cost attached to this pandemic. And I think more or less there is a general consensus that the government needs to step in significantly and help cushion the economic stress due to this pandemic, which of course means that we are expecting a much larger increase in government expenditure compared to business as usual. And then of course there is this question of how this additional expenditure should be financed. There are, of course, several, ideas. MMT, I believe is the most intriguing in terms of giving us a new perspective. And about, how should the additional expenditure be financed? It also assumes very special importance because this question is being asked against the backdrop of the 2008 global financial crisis and its after effects. We are still living in a world which is grappling with the problems, of unemployment, grappling with the problems of anemic growth, grappling with the problems of rising wealth inequality. And hence, this question assumes special significance because it's not just a question about how should we finance the additional expenditure, but it's really a question of how should we look at economics, in general. Now, if we look at just give me a second. Now, if you look at the record of history, it's absolutely clear that every time there has been an adversity, there has been a change where old ideas, have been questioned and new ideas have been discussed. If you look at the period before, the 17th century and the 16th century, the adversity really was that, the society was still predominantly organized as a feudal society, as an aristocratic society. And a large proportion of the population felt that their aspirations are not being met, and which led to a movement to shift, to a more industrial society, which had a different value system altogether. This period led to the emergence of classical economics. It's the birth of economics as we understand it today, literally the birth of economics as a discipline itself. We all, of course, know Adam Smith's famous book, The Wealth of Nations, in 1776, which introduced classical economics to the world. Now, even within this, not everything, was perfect. Between 1880s to 1970s, these classical economic ideas, which are more commonly referred to as free market ideas, they saw a backlash because there was a feeling that under the old system, exploitation had not vanished. It's just that, there was a new class of people who are now being exploited, which is the labor. And this was championed by Karl Marx. And in fact, the same year that Marx died in 1883 was also this year in which John Maynard Keynes was born, who again played a seminal role in challenging the old ideas. And it's again very important to notice in this discussion that each of this time when something new came was a time of great economic upheaval. So for example, when John Maynard Keynes was talking about his ideas, those are against the backdrop of the Great Depression in the 1930s. And Keynes questioned the balanced budget hypothesis, which was the cornerstone of classical economics, sound money as we call it, that the government should balance its budget. And Keynes thought otherwise. Keynes thought the government should run deficits or surplus depending on what the state of the economy is. And he's credited with the emergence of fiscal policy, as a tool to regulate the economy, and which was used widely not only to fight the Great Depression, but also to finance the Second World War, as well as do the post Second World War reconstruction. By the time 1970s, because of the stagflation during that period, there was a general feeling that maybe we had gone too ahead in the path towards increasing the role of the government in the society. Maybe we need less regulation. Maybe we need to again roll back, the activities of the government in all the sectors of the society. So it was the birth of neoliberalism, which is nothing but simply a resurrection of the classical economic ideas, but in a new avatar. I think the neoliberal period, can be said to have come to an end, or at least been significantly questioned post the 2007 global financial crisis. A lot of blame for the crisis was taken by this doctrine of neoliberalism. And what we have seen post 2010 is that there has been a yearning for new answers. A lot of time, if you look at the critique of economics as a discipline, you will see that a lot of people post the 2008 global financial crisis, there really hasn't been the same kind of upheaval in economics which happened during earlier periods of adversity. And I think modern monetary theory is partly, the answer to that, and or maybe the answer to that. It's the leading theory which is really challenging old ideas, and it really questions a lot of things that we today just assume as being basic truths. So on that note, I'm delighted to hand over the baton to Dr. Warren Mosler to take us through the modern monetary theory. Over to you, Warren.
Okay, very good. Thank you. Sorry for adjustment. I must have got the time wrong or something. I thought I was a half hour early.
I think you're in time.
Okay. Am I okay? Good.
Yeah, good.
Okay, because it's just 9:42 here. I was thinking 10 o'clock start. Oh. Erupted maybe 2,000 years ago, and they excavated it and found this whole city under all the lava. And we went in there and jumped on a tour. There was probably 30 or 40 of us, and we had a tour guide, and he was showing us around. And then he showed us these coins. See that? These coins that, and he started talking about the coins. And he said Pompeii was a very nice place to live because the government would collect these coins for tax payment, and then they would pay people to do public services. They would be the police to keep it safe. They had sanitation to keep it clean. And so people wanted to live there even though there were high taxes. So, I'm a little bit of a troublemaker. And I said to the guide, I said, well, you know what? The way it actually worked is that they would pay the people first, and then they would collect the coins. And, I'm going to turn this. Okay, he's still there? Okay, I've never spoke watching myself move my mouth in a video, so it's a little disconcerting. So anyway, I said, look, they pay the people first, and then they would collect the coins. And let me get that off. I can't. Okay, they would pay the people first, and then they would collect the coins. And he said to me, no. The government collects tax, and then they pay people. So I said, well, where did the coins come from? And he said, the government made them. So I said, okay, well then how did anybody get a coin to pay the tax? And he said, you mean so they have to pay the people first before they could collect the coin? And I go, well, yeah, of course. How else can it work? He grabs his head and he goes, no. He walked away and he wouldn't talk to me for the rest of the tour. Well, look, everybody in Pompeii knew that the government paid the people first and then collect the coins. Okay, but that knowledge has been forgotten. And what I'm saying is the same thing is true today in India and the United States and anywhere else, that the government is the single supplier of the thing that the population needs to pay its taxes. The government, through its agents, and agents can include its banking system or whatever, but the government and its agents are the single suppliers of what the population needs to pay taxes. And so naturally the government has to spend first before taxes can be paid or bonds can be bought. And everybody in the central banks know this. Everybody in the RBI knows this. The way they say it is a little different. They say you can't do a reserve drain without first doing a reserve add, but it's the same thing. You have to add the funds before you can take them out. Okay, so there are a lot of other lessons we can learn from Pompeii. So for example, the guide told us that they found 20,000 coins in the street. Okay, so, or what would have been somebody's pocket, or what would have been a cash register, or what would have been under somebody's mattress. So how did those coins get there? All right, so the government obviously must have spent more coins than it collected for tax payment. If they found 20,000 coins in the street. Maybe over time, the government had spent 100,000 and only collected 80,000. And it spent more than it collected. Okay, the accountants call that deficit spending. Deficit spending is when you spend more than you collect. And the government's deficit of 20,000 coins is measured by the coins in the street. And that was the money supply for Pompeii. And likewise today, the public debt for India consists simply of all the rupees spent by the government that have not yet been used to pay taxes. It spends more than it collects. They stay in the street until they're used to pay taxes. Now, in the street is different today. By in the street, we mean in bank accounts, and specifically, these are bank accounts at the RBI, and they call these accounts, I believe, reserve accounts and securities accounts, but they're just, your public debt are just rupee and bank accounts at the Reserve Bank. And it already is the money. There's nothing to pay back. They can shift those rupee from one type of bank account to another, but paying it back, the concept is not even applicable. That's like saying in Pompeii, okay, they've spent 20,000 coins more than they collected. They're in the street, that's the money supply. How's the government going to pay it back? It's like, what do you mean pay it back? Well, the accountants call that the public debt, so they call it debt. That means you have to pay it back. It's like, no, you don't. You're completely missing the point. So the next thing I want to use this analogy for is to explain where the value of a coin comes from, because everybody's always talking about inflation, this or that. So where does the value of a coin come from? How does the price level get to be where it is? Now, of course, mainstream economics has no theory of how the price level is where it is. They just say it's there historically. Their theory tells you why it changes from year to year, and they use expectations and whatnot. But I think what you'll see from this is that they've completely missed the source of the price level that, at this point, only MIT correctly identifies. Okay, and that is, and let's just, for example, say that the government of Pompeii, the city, had placed a tax on everybody's house. And you had to pay so many of these coins a month, and they weren't gold coins. They were just inexpensive metal that the government would mint. But you have to pay so many coins a month for tax, or else you're going to lose your house and you can't live in Pompeii. So what they've done is created a need for their coins. Now you've got the population needing these coins, and the people who needed the coins had different ways of getting them. They could show up to the government and look for work, or they could sell things to people who showed up to the government, who were getting paid. But for the society as a whole, it had to produce people. People would go to work for the government to earn the coins. They would get paid, and then those coins would be used to they monetize the rest of Pompeii. So what is the value of a coin? Well, the value is what the government says you have to do to get it. And what I'm explaining is how a monopoly works. And the nice thing is monopoly is the simplest thing in economics. You learn it in Micro 101. It takes about 15 minutes, and then they move on to the next thing. Because there's no market forces. There isn't anything like that. There's just a single supplier of something that's needed. So the government here is a single supplier of the coins that are needed to pay the tax. And so they would tell you how many coins they're going to pay you. We're going to pay you 10 coins a day to come work for us. We're going to pay you 1 coin a day. We're going to pay you 10 coins a week. They could say whatever they want. The people needed the coins to pay the tax. They are what is called price setter, not price taker. That's what monopolists are. Monopolists set price because there's no market. There's no other way to do it, right? And so let's say the government said we'll pay 10 coins a day. Let's say we pay 1 coin a day to anybody who works for us. Well, now what's a coin worth to the rest of the economy? The rest of the people who don't want to work for the government and want to sell things to people who do work for the government. Well, a coin is worth, the relative value of a coin is the value of a day's work for the government. And so some people would say, I'd rather spend my time working for the government, and I'll go earn a coin, and then I'll buy the food I need, the pizzas I need from the local pizza maker. And the pizza maker would have to say, well, I really don't want to go work for the government as a police officer. I'd rather make pizzas, and I'll sell, at 1 coin a day, well, I can, in a day's work, I can make 10 pizzas. So, a coin is worth about 10 pizzas. And I don't know what it would exactly be worth, but the markets would determine some kind of relative value. Right? And let's say it came up to 1 coin. You have to work 1 day to earn a coin as a public servant. And the indifference levels, the fair market for that was 10 pizzas. Well, nothing is going to change that unless relative value changes in the economy. But in general, it's going to stay about the same. Now, if the government decided to pay everybody 2 coins a day instead of 1 coin, okay, now a coin is only worth half a day's work. And so now a coin only buys 5 pizzas. The same day's work gets you 2 coins, which buys the same 10 pizzas. So by paying everybody double, all the government did was reduce the value of their coin by 50%. And they used to call that crying down the value of the coin. Kings used to do that. By the way, all the kings used to do this. This is how Arthur the Great ran his kingdom. This is how the Romans ran their empire. They would have a tax payable in their coins, and then they would be able to buy things from the people because they needed the coins to pay the tax. Okay, so the source of value is what the king or the city of Pompeii said you had to do to get the coin. It was what you had to do to get it from them. And the harder they made it to get, the more valuable the coin. The easier they made it to get, the less valuable the coin. Now, I'm going to just wrap this up by talking about unemployment. So what is unemployment? How did it happen? Where does it come from? Why is it there? Well, when there's no money in the system, there's no unemployment, because unemployment is defined as people looking for paid work. So if you have a situation where you don't have a monetary system, maybe the people in Pompeii before there was a tax, way back before the Romans were there, you had an agrarian society. People are working in the fields. They're hunting, they're fishing, they're growing food, but there is no taxation. Maybe you're out in the outback in Australia in a sheep station. There are no unemployed. There are no people looking for paid work because there's no money. So what happens is the government, a state at some point determines it wants to provision itself. It wants people to shift to labor to move from the private sector to the public sector. And so how do they get it there? Well, the same way they did in Pompeii. They put a tax on everybody's house. And the purpose of that tax wasn't to collect coins. They already had the coins. The purpose of the tax was to cause the economy to need the coins. They had to create a need for the coins. Okay, they had to create people looking for paid work, and which is our definition of unemployment. So they had to create unemployed people looking for paid work, so they could then hire them with their otherwise worthless coins to do the public service work. So what we say is that the cause of unemployment is taxation, and it's by design. The purpose of taxation is to create unemployed people so the government can go hire them with its coins. All right, and so if the tax creates more unemployed people than the government wants to hire, okay, then those people are left over. The tax created 1,000 unemployed. The government only wanted to hire 500, so it does only hire 500. Then you've got 500 people unemployed in the street. It's because the government created this situation, okay? And it would never happen in Pompeii because they understood it. If there were more unemployed people than the government wanted to hire, they would either go ahead and hire them anyway, or they would reduce the tax. And they recognized the entire responsibility for unemployment is that fiscal policy was out of balance, okay? The tax creates unemployed. They need the coins for only one of 2 reasons, 2 possible reasons, either to pay the tax or to accumulate coins to have a money supply to be able to do business, to have savings, right? The 20,000 coins in the street were the people's savings. Okay, so what I say is unemployment is the evidence that the government that created the unemployment hasn't spent enough, okay, to satisfy the need to pay the tax and to save. And to save is a residual need that's also created by the tax. The tax creates a need to pay the tax and the desire to save in that currency. And I think those are everything I have in my notes. I just want to add one thing. Once you have coercive taxation, the government is the monopolist that creates the demand on the taxation side, and it's the supplier, the single supplier of the coin. You no longer have a free market situation. The whole economy is monetized to this monopolist, and the notion of a free market is totally obviated. It's just not applicable. You now have a situation of a monopolist, running the system. And so you have to take, all your other models have to take that into account, or they're going to be not entirely applicable to what's going on. Okay, thank you very much.
Thanks so much, Warren. Dr. Van, would you like to share your screen?
Yeah, I'll do that. Yeah. Okay. Are you able to see the screen?
Yes.
Okay. That was a very intellectually stimulating way of looking at the world of government creating money and also taxation causing unemployment, etc. It will take a while for me to sort of sink that all in. So I'm going to go with the common understanding of what we call modern monetary theory or deficit monetization, which is more familiar to us. Of course, the title is somewhat partly in English and partly in Indian language. Is deficit monetization the Sarvaroga Nivarani? In other words, is it the cure-all solution to the problems that India faces, or for that matter, the United States faces, which is all about basically stimulating demand, creating employment, as he says, which is, so instead of taxing, you actually spend more. The government spends more and creates employment, or hires people, or facilitates the hiring of people. So is that the answer? So I would just want to leave, I'll repeat this in the end, and I also mentioned this right now. There are a few things that we need to understand in terms of the rule of public households behavior, people behavior that affects economics. So for example, we know that in any situation, what we have, we tend to take it for granted. And the moment we lose it, then we regret, we miss. So the loss aversion is very high. So for example, take the current situation when some of us seemingly don't have much to do sitting at home, and we are complaining and we're not able to travel. But at the same time, let's say we are not as worse off as others. We have our jobs, we continue to make our income, but still we think life is kind of constricted, it's frustrating. And then 1 year later, when all this coronavirus fears are gone away, there is a vaccine or whatever, and we are back, then we will look back and say, oh, that period last year in 2020 seemed nicer. We were at home with the family, catching up with everybody. All of us were around the same place. We spent more time discovering other interests we had. Oh, that was actually a good time. But that's how we would react 1 year later. But when it actually is happening, we all feel very frustrated. So the human nature is asymmetric. We tend to take what we have for granted or don't value it. But once it is not there, we value it. So the kind of value we attach to things that we don't have, it is not same as what we can think of them when we actually have them. So there's asymmetry. A lot of things are asymmetric in the way we react. So that's the same way economic policy impact, economic variables also affect other things in a symmetric manner. For example, central banks can probably raise interest rates sky high and somehow restrain credit demand, bring down the economic activity, slow down aggregate demand, and bring down the prices. But for them to be able to create inflation by printing money isn't seem to be happening, because there is psychology of people undergoes a change. So they're able to control the inflation once it is high, but they're unable to lift the inflation rate once it is low. which we have seen that happening over and over again from Japan to Europe to other countries in the world. So clearly there is asymmetry. That is one rule we have to remember. Policy impacts the real world asymmetrically. Second rule, there is always the law of unintended consequences which will play out. And the third rule is the road to hell is always paved with good intentions, precisely because there will be unintended consequences. So these three axioms do not just apply to economics, but more so to public policy making. We should remember them. So that is why sometimes it's easier for governments to hurt the economy, society, than it is possible for them to help. So that is why the first motto of public policy is similar to what doctors have: do no harm. Okay, and then we can think of helping people. So the next slide, wait, I don't know why the slide is not moving. So let me move the slide. Okay. In general, central banks were created to help governments finance wars, or the monarchs. The monarchs faced a problem of time inconsistency. They couldn't pay back when the people wanted, those who borrowed money. So the borrowing is needed now and the paying back will happen later, and they had a credibility problem. Therefore, they could not credibly commit to their promises to respect property and to pay debts. Therefore, the solution was to delegate power over government decisions to Parliament and the central bank. Okay? In general, the forerunners of modern central banks were not born of the need for monetary services or a lender of last resort, not to help the banking system. Instead, their primary impetus was to improve government's abilities to issue debt in wartime. Because the people who lend money to the king had to be reassured that they would be paid back, and also that money will have the same purchasing power when they got the money back. And given the temporary nature of wars and the efficiency of spreading its costs over a long period through debt financing, it was very sensible, rational for the monarchs or the governments to consider charting special banks as havens for its government debt. Economic historians have indeed found war finance to be the main factor in the rise of central banks. So today, when we talk of central banks being able to directly finance the government, we seem to be going back all the way to the very origins of central banking, which was meant to help monarchs pursue their ambitious plans of expanding the empire. Of course, the reason why we moved away from that and created some of these institutions as different from the executive is precisely because those who lend money to the sovereign, to the king, wanted to be repaid, and that those repayments have purchasing power as well. So clearly, that's one of the reasons why eventually over time we moved away from central bank's role as purely financing the war, but also to preserving the value of money. That became more important, even though initially that was a secondary purpose. Okay, and the next slide shows you. So when you talk of the central banks, one of the earliest ones, not the earliest one, but one of the earliest ones was the Bank of England. The Bank of England obtained the power, because of being the banker to the king, to affect general credit conditions. A power which the government took advantage during Napoleonic Wars because it pressured the bank to finance the war through inflation. That is, you borrow today and then you repay in weaker currency through higher prices, then obviously you are financing the war through inflation. But since this redistribution happens intersectorally, obviously those who lend and those who benefit when the government spends money are two different people. So political alignments followed suit with the divisions between creditors and debtors, tradables and non-tradable. Non-tradable people benefit more with inflation. Tradable goods suffer because of competition, unable to export. So all these things effectively mean redistribution. So that is why inflation is a problem. It also means redistribution between different sets of people: lenders, borrowers, savers, spenders, and tradable, non-tradable, etc. So what happened was that once the government relied on a central bank to finance the war, the temptation always is to reduce the payment obligation by creating inflation. That is one of the reasons why the central bank and the executive got divorced over time into independent entities. That is the point I want to make. So, of course, in the early stage of the Napoleonic Wars, the Bank of England suspended the gold payments due to pressure from the government to finance war effort, because earlier there was a convertibility, but naturally once you want to print more money, the value of money relative to gold goes down, and naturally, therefore, gold convertibility is no longer feasible. People don't want to hold money, they want to hold gold. So the government will run out of gold. So the gold convertibility is suspended. It lasted nearly 30 years, and in the interim, the bank became little more than just the monetary arm of the exchequer, of the treasury, of the government. The result was inflation and depreciation of sterling against other currencies. The bank thereby usurped the property rights of all persons whose wealth consisted of money. So naturally, there again, you can see that there is a redistribution that's happening through inflation. So that was more like a prologue to set the stage as to why certain things we have moved on, and now almost in a war-like situation, some of these ideas are coming back. In general, I also strongly believe, as Dr. Warren Mosler also pointed out, that fiscal policy over the last 30, 40 years has been given less importance, and monetary policy has gone into the hands of experts and the elites, and they're considered somewhat uninfluenced by political considerations, short-term considerations. But you must think about it this way. Monetary policy is not made by democratically elected people. It is made by technocrats. In a sense, it's undemocratic. Fiscal policy, right or wrong, is made by elected representatives, and they are chosen by the people, and they are democratically accountable. But in the last 30, 40 years, as part of the anti-inflation, globalization, central bank independence policies, etc., fiscal policy got downgraded. And you look at the textbook by Fisher, Dornbush, and Starts in chapter 12, they show monetary expansion increases equilibrium income and brings down the interest rates. Whereas a fiscal expansion does increase incomes, but it also increases interest rates. And therefore, fiscal expansion is a combination of win and lose, whereas monetary policy expansion is a combination of win-win, higher income, lower interest rates. So they said monetary policy is more suited for stimulating and influencing aggregate demand rather than fiscal policy. And it also means that power passes from the hands of elected representatives to unelected technocrats. So I am all for restoring the balance between democratically elected representatives and the central bank. So in a way, fiscal policy becoming more important is a good thing comparatively over the last 40 years. In fact, Paul Tucker, the Bank of England deputy governor, wrote a book called The Unelected Power about central banks. And he said it is time that the unelected power actually is diminished and central bankers are made more accountable. Therefore, to some extent, fiscal policy becoming more important as a vehicle for controlling aggregate demand is a good thing in principle. However, talking of India, Reserve Bank of India, so George Schuster, the finance member of the Viceroy's Executive Council, said in 1929, when the RBA Act was being envisaged, the largest user of money is the government. And the whole principle of the proposal is that the government, when it wants money to spend, should have to raise money by fair and honest means in just the same way as every private individual has to raise money, which he requires to spend for his own maintenance. If the government is in control of this authority, which is responsible for exercising the other function, then all sorts of abuse can intervene. So clearly, even right then, he was making the case for central bank not being simply the financing arm of the government, because he said it would give rise to all sorts of abuse. So what is that abuse? First of all, in general, there are so many people talking about this modern monetary theory. As I always mention, some of these interesting terms are used with a normative purpose. For example, we talk of innovation in finance. We talk of the word transparency. And then we talk of modern monetary theory. These are all very value-laden terms. Nobody can stand up and say, I'm against innovation. That makes you sound like a Luddite, or just basically somebody who doesn't value progress and change. You can't stand up and say, I'm against transparency. I mean, central bank transparency actually hasn't helped anybody except speculators, because the real economic activity doesn't need the central bank to be fully transparent, and sometimes surprises are really what helps policymakers to be effective. But all financial market participants like policy to be surprising if it is a rate cut, but they don't like rate hike surprises. So they want transparency so that they can plan their risk management and speculate if central bank is transparent. So they use the word transparency so that nobody can stand up and say, I don't like it. Then you will be considered a very opaque and a very mysterious person who has dark motives and aims. In the same way, deficit monetization is simply central bank financing the government, is now accorded this phrase modern monetary theory, but this is neither modern nor monetary nor it's a theory. It is just a practice. That's why I showed you those 4 slides earlier, which shows that central banks initially started off with this purpose in mind. So it has been there for the last 300 years or so. It is just a question of borrowing today from the public to pay to pay for your war expenses, but paying them back in a lower value money, and that is modern monetary theory to some extent. So we shouldn't be taken in by these phrases. We should see them for what they are. And that is why there is a pros and cons to both of it. So while I like the idea of fiscal policy being deployed to manage aggregate demand, we should also remember the risk of inflation, because we will never know when to stop. That's the problem. So the difference, of course, the positive difference, which I completely buy into, is quantitative easing is an activity pursued by the central bank wherein they buy government bonds from the secondary market, from the primary dealers, and credit the accounts of those banks. So they create bank reserves. But then the onus is on the banks to go out and lend, which they may not do if there is no appetite to lend or appetite to borrow. So that's why quantitative easing can create a lot of reserves, but whether it reserves get translated into loans, because normally the way the system works is that banks make loans and then they create reserves. It is not the other way around, where central bank credits reserves in the bank's accounts and then they go out and make loans. So the whole idea of QE gets the theory of how lending happens in the reverse. That's why it doesn't work. It hasn't worked really in Japan for 30 years. And it hasn't really worked in the case of the US or UK or BOE or ECB, etc., because the speed with which the economic activity recovered post-2008, in spite of these massive operations, has been one of the weakest recoveries in the post-World War II era. Because QE initially creates reserves for banks held with the central bank, and the economic activity depends on the banks going out and using those reserves and multiplying them into loans. Whereas deficit monetization does the opposite. The moment the central bank credits the account of the government now has the ability to spend and pass it on to people in the form of work programs, settle its outstanding dues to contractors, and send welfare checks, whatever it is. And then those monies, some of them get spent, some of them get saved. In some form or the other, it comes back into the banking system as reserves, no doubt. But before it comes back as reserves, it has created spending power, it has boosted income. So reserves come into the banking system as a consequence of economic activity, whereas in the QE, reserves become the cause of economic activity, but it may or may not become the cause. That is a very big difference. So that is why deficit monetization is like a direct injection into the economy, whereas QE is an indirect injection, which may or may not work. But the question is, in the case of the United States, there is a very thin sliver of difference between QE and deficit monetization, because the Federal Reserve stands ready to buy as much as is required from the primary dealer, so that no treasury auction can ever fail. But there is an important distinction. In the QE, the central bank is separate, the government is separate. In deficit monetization, they just become one. Because all said and done, QE is pursued by the central bank to control the interest rates. It is not meant to finance the government, although in practice, in the United States, it has turned into financing the government, especially now post-pandemic. But in reality, QE can be considered as separate from fiscal policy or deficit monetization. Deficit monetization is direct combined entity of the central bank and the government becoming one. So there is this fig leaf of separation between central bank and the executive that gets lost in deficit monetization. However, the situation in the case of India is very different. Right now, India, if it goes out and borrows, it has the potential to raise the interest rate, 10-year borrowing cost. And already with the deficit being what it is, if bulk of the borrowing goes towards financing it, then the effectiveness of government spending will go down. That is why my co-author and I argued in a piece in Mint 2 weeks ago for deficit monetization in principle to be done by India with a limited $50 billion, which is equivalent to about 2% of GDP, and not necessarily keeping it open-ended, because there will be consequences if government of India keeps it open-ended. Then there will be temptation to resort to this again and again, and we'll go back to where we were pre-1997. India's inflation rate between 1960 and 1991 was around 7%. It came down to 5.8% between 1991 and 2016. So in some sense, the practice of stopping the issuance of ad hoc treasury bills did play some role in muting inflation, although I believe inflation is a function of many other factors also. But the truth is, if you make it open-ended, then the temptation to resort to it as a first option will be irresistible, and it will lead to all sorts of consequences on the exchange rate, etc., etc. So, but for a reserve currency like US dollar, because in theory everybody has to hold dollars, it may look like there is no barrier, as in the case of India, because all said and done, financial markets do treat developed countries and developing countries differently. So what is the problem if the US were to engage in quantitative, in deficit monetization? Now, the consequences could be quite geostrategic, especially as we stand today with the United States facing a very, very important lesson in recent memory, maybe since the Great Depression. And there are geostrategic implications and geopolitical forces operating to unseat the dollar as a global reserve currency. It can lead to perception that the United States is actually losing control of its money supply, with consequences for confidence in the dollar, etc. And people say that it didn't create inflation in Japan. Why should it create inflation in the US? But before we even turn to inflation as a consequence and interest rates as a consequence of deficit monetization, let's look at its effectiveness. In the last 6 months or so, the Federal Reserve has thrown the kitchen sink at the problem. But the truth is, about 10% of the American population said in the week between July 14th and 21st, they said they had problems having sufficient meal. Nearly 30 million people said either they didn't have enough to eat or nothing to eat. This is in spite of the fact that so much of money was thrown at the problem, including payroll protection program checks, small business loans, etc. So the question is always one of effectiveness. Who benefits? What is the intended purpose and what is the actual purpose? Does deficit monetization lead to real economic activity support, or does it end up purely supporting online trading through Robinhood and buying bankrupt company stocks like Hertz, etc.? So, and then at the same time, in these 4 months, when at least 10% of the Americans have been complaining about not having enough to eat, you also have the situation where the Apple stock went up 100% in just 4 months. So it's important to keep in mind, where does all this actually go? The second question to remember is that in the United States, if the federal government were to send checks and create more programs because it is able to be financed by the central bank, then the overall current account balance will blow out of control. Japan, in spite of 30 years of low growth, etc., because of demographics, has been having a current account surplus of around 2%, whereas the United States is now running current account deficit of 2%. So if the economy as a whole is a dissaver, then somebody has to save, which means the external people will have to lend money to the United States. So the current account deficit, once it blows out of proportion, then the confidence in the dollar could be undermined as It was the case in the 70s and also sometime in the new millennium when the euro doubled against the US dollar. And next point, why the United States could have a problem is that Japan, all said and done, is a net international creditor currency. It is actually 60% of the GDP is Japan's overall external credit to the rest of the world, whereas the United States is actually a net international debtor. So in the case of Japan, you can see here, in spite of all this deficit monetization, its GDP as of 1994 was $5 trillion. And its GDP as of December 2019 was just $5.118 trillion. Effective growth rate in dollar terms per annum in the last 24 years was barely 0.08%. And in Japanese yen terms, it was 0.36% per annum, in spite of all the deficit monetization that the Bank of Japan has been doing. So where is the effectiveness? And this is the US net NIIP, which is a very big negative number. So all I'm trying to say is that if US were to do what Japan has been doing, although it may not have an implication for interest rates right now, it could have implications for the current account deficit, for the US's net international investment position, and therefore for confidence in the dollar, which in the current circumstances could turn out to be rather a serious risk for the US's stature as a preeminent country in the world. I think in general, inflation targeting, I agree, it benefited basically creditors and the property owners, etc. And right now, the last 40 years, we have felt in the developed world, workers haven't benefited. So some amount of inflation will actually be better. And there is no scientific basis for 2% inflation rate having been chosen. So a deficit monetization, to the extent that it creates inflation, is a good thing. But again, for India, we should be careful because we always have supply side bottlenecks. And inflation, if it gets out of control, even now, if you look at the RBI survey, you notice that the household inflation expectations are running at 10% in the next 1 year. That is why I said India can resort to deficit monetization, but as a limited one-off exercise. Whereas in the US case, it is good to create some inflation expectations, especially because it is going to help workers to restore the balance between capital and labor. But if it runs out of control, it will have implications for current account deficit and for the role of the dollar in the global international reserve currency markets. It's always about balance of power. So we should be very careful about not overdoing it, because eventually the workers will lose out if inflation becomes too much as well. So this is exactly the point that is made here. Suspension of gold standard had general ramifications because its consequences between inflation and depreciation brought about a redistribution of wealth from creditors and producers of non-tradable goods to tradable producers. So normally inflation and currency depreciation benefit tradable producers, and which is a good thing. But the US does not have any manufacturing capability left. So even if the currency becomes weaker, we have noticed that the United States doesn't really generate a trade surplus. It did not happen between 2001 and 2007. If anything, the US current account deficit went up to 6% of GDP between 2001 and 2007. Whereas for a country that has a manufacturing base, currency depreciation can help at least in the short run. So that too is a factor to keep in mind. And then last point, I overshot my time quite a bit. The last few points I want to make is that everybody who has some idea of how the global cycles turn, institutional cycles and socio-economic cycles are all converging in this decade as a very pivotal one for the US. So it's going to be a decade of churn in the US society. We are seeing it already happening in society and in the economy. And therefore, to throw in deficit monetization into the mix and creating doubts about the dollar might become too much of a volatile cocktail for the US to manage. I would also leave with you one more last slide. The fate of empires over the last 600 years, no empire has lasted more than 250 years. And the United States got its independence in 1776. And this decade is therefore converging to be the 250th year. 10 generations is what the maximum life cycle of empires. I would recommend you this paper and also the book, The Fourth turning, which you should read. This paper is available for free download. You must pick it up and read. And this is a wonderful understanding of how things might unfold in this decade in the United States, regardless of who wins the elections on November 3rd this year. And then lastly, this slide is from the Economist magazine, 2012, June. It clearly tells you that the bulk of the economic output since the beginning of the AD was created in the 20th century. That is why the tall dark blue bar. But the interesting point is the first 10 years of the 21st century created 23% of all the output since AD 1. And therefore, it exceeded the output created in the first 19 centuries. In other words, the enormous amount of debt and liquidity we have created has concentrated economic activity in the last 60, 70 years so much that we definitely have borrowed far too much from the future and brought them forward to the present. And we can't do that. That is why, in spite of all our money printing or deficits or reduced interest rates, etc., the millennials are having an uncertain future and societies have been divided. That's why I said we need to therefore remember three things: law of unintended consequences, the road to hell being paved with good intentions, and if there are free lunches, it would already have been had. So my final message is India could do a limited one-off deficit monetization given its interest cost obligations, but it cannot overdo it because it will have implications for currency depreciation, for inflation, etc. For the United States, if the QE and deficit monetization is only a very small sliver of difference between the two, but if they engage in it now, it will have implications both geopolitical and geoeconomic and for the status of the United States dollar, because United States is not Japan. I will end my message here. My apologies for overshooting my time. Back to Ravi.
Great. Thank you so much, Dr. Van, for that very extensive overview. I'm sure everyone would have found it very, very useful. We'll now have a brief discussion before we move on to the Q&A. I see in the Q&A tab that we have a lot of questions coming up. So I'll keep the discussions brief, but I'll first, I have a few questions for Dr. Mosler before coming to you, Dr. Van. So Warren, you gave an overview of MMT, and I just wanted to delve a little more on that, so that just to be sure the audience fully appreciates what modern monetary theory really is. I think the first clarification that I would like you to throw light on is modern monetary theory a new theory, a radical theory which says very new things, or is it the correct understanding of how monetary operations work? I think it's very important to clarify, that will be helpful for the audience to understand the theory better.
Okay, so the important contribution is that the currency itself is a functioning public monopoly, and that mainstream economics has the sequence backwards. What I just heard was a consequence of the mainstream understanding that the government has to get money to spend. And if you ask any congressman, any member of parliament, they say we have to tax to get money to spend, and what we don't tax, we have to borrow and leave the bill to our children. What modern monetary theory recognizes from an understanding of monetary operations is that is backwards. And every senior staffer in every central bank in the world recognizes that is backwards, that the government spends first, and then taxes can be paid or bonds can be bought. And when you have that backwards, you get that whole lecture we just had was premised on the reverse understanding. So in that sense, I would fundamentally disagree with the premises of much of what was said, but some of the conclusions are probably okay, but the premises are just not grounded in actual monetary operations. So for example, let me get back, in case this never gets to happen, the way things are going. The topic is funding India's deficit, is that correct?
Yes.
Okay, so could I address that for a moment?
Yes, yes, yes.
Okay, so look, the guide in Pompeii would say, oh, they have to raise taxes to be able to pay everybody. And I'd say, no, they have to pay people first before the taxes can be paid. The guide would say if they didn't get enough money to pay everybody, they had to borrow 20,000 coins, and that's how they borrowed it from the money in the street. I'd say, no, they spent the coins first. If they wanted to borrow them, they would have to borrow them after they spend. So it's the same thing in India. If you look very closely at the accounts in the central bank, which is the scorekeeper for the rupee, it's the government's agent for the rupee, somebody has to keep the spreadsheet. They spend first and then taxes get paid. They spend first and then securities get purchased. Now, I'll say spend or lend, but technically lending is a form of spending. It's spending on financial assets. So let me just say spending, and that covers lending also. So the central bank, Treasury, somebody has to credit the accounts before they can debit the accounts. And so the idea that India has to finance itself in the sense that it has to get the money first before it can spend is not the correct understanding of what's going on at the operational level. Okay, so India is spending first, and then some of those rupee get used to pay taxes, and then the rest they decide whether to leave them in reserve accounts or to shift them to securities accounts, to borrow them. And borrow them is simply the matter of shifting it from one bank account at the central bank to another. So let me just jump to the conclusion, not leave a lot of time. India can run any size public debt it wants to without worrying about finance. And I would recommend just selling 3-month bills, but it could sell any length of securities it wants to. It doesn't have to worry about whether the market will buy those securities or not, because the institutional arrangements are already there within the central bank, within the RBI, to ensure that the checks will clear. Okay, so the spending originates with the legislature authorizing the spending. It doesn't originate with the central bank providing money to be spent. Okay, the legislature authorizes the spending, and then the institutional arrangements already in the central bank will ensure that Treasury securities will be sold, government accounts will be credited, then government accounts will be debited, private sector accounts will be credited, so that the spending authorized by the legislature takes place. And India's never had a problem financing the debt for as long as it's been on a floating exchange rate. Okay, and so it's not going to have any problem. So the whole question here about funding India's deficit is kind of moot. It doesn't, whether there's monetization or not monetization, makes absolutely no difference to the outcome, which is money appropriated will be spent. The interest rates paid by government will be the policy rates set by the central bank, whether or not there's any monetization. It doesn't make any difference. So let me now answer your question, now that I've had a chance to get that in and we've covered the subject matter at hand. Okay, so the MMT response is that funding India's deficit is not an issue regardless of whether there's any monetization or not. And MMT is certainly not, the understanding of MMT is not that debt should be monetized or not monetized. That's not it at all. Okay.
That's helpful to know. I just wanted to, regarding your point on, how India can finance its economic stimulus bill. Yeah. Let me take the argument a little forward, and let's assume that, and I remember discussing this with you, and it would be good if you can throw more light. What if the RBI refuses to monetize? Like, do you see any, and the government has to directly approach the bond market for its borrowing requirements? Do you see any problem in that?
Well, I'm not an expert on the institutional arrangements, but I assume they're similar to the United States. So, and this will get a little bit technical, but you have a series of dealers in India that we call them here primary dealers that
it's similar, yeah.
Yeah, that act as agents of the central bank. Their assigned purpose of buying the debt in the auction on behalf of their clients, who are all the other investors. And they are given credit lines by the RBI, by the central bank. So they can buy as much of the debt as they want and borrow the money from the Reserve Bank to pay for it. And then when they sell it to their clients, then their clients pay for it and they pay off their debts to the Reserve Bank if they've used it to borrow the money. And they are in competition with each other. The debt will go to the highest bidder, the one who's willing to give the government the lowest yield. And the way it works is that the money that's being borrowed is the money that's being spent by the government first, okay? Or think of it that way. It doesn't need to be in that sequence, but it's the money spent by the government. So it's, when you have deficit spending, you have the government spending more than it collects in tax. And that extra spending is credited to what are called reserve accounts at the RBI. Those rupee in those accounts have nowhere to go except sit in those reserve accounts. Okay. What's called the debt, the bonds, those are just alternative accounts at the RBI. They're like a normal bank would call them checking accounts and savings accounts. At the RBI, they call them reserve accounts and securities accounts. So what they do is they offer the spending causes the reserve account balances to grow to a certain size. If the spending's 100 billion rupee, then this reserve accounts would grow by 100 billion rupee if nothing else was done. And then they offer to the holders of those rupee, they offer them alternative accounts called bonds, securities accounts, and they let them compete with themselves to decide who is willing to accept the lowest interest rates to shift their rupee from the reserve accounts at the central bank to the securities account. So it's like if banks only had checking accounts and they didn't have savings accounts. They said, look, all you people who are in checking accounts will offer savings accounts, and we'll allow you to shift to savings accounts based on whoever accepts the lowest possible yield. So all the people with money in checking accounts are offering, giving the government their offer of, okay, if you give me, 0.1% higher than I'm getting in my checking account, I'll move it to a savings account. If you give me 1% higher, 0.25% higher, 1 basis point higher, and it's competition, and it goes to the ones who are willing to accept the lowest rates. And also these primary dealers have to maintain a certain percentage of the market, they call it a market, for shifting reserves between reserve accounts and securities accounts, or they lose their ability to deal with the major customers in the world, which is a lucrative business. So they're willing to do this at very low rates just to maintain their market share, so that, and they'll even lose money at it. So it's a good deal for the government because they want to retain the ability to service the rest of their clients. So the shortcut answer is the institutional arrangements are already there for all the government debt to get sold at the lowest possible interest rates, for any size, because the spending creates the money that is used to buy the securities, to the last penny, as we say here, to the last rupee. All right, and so, and if there's a difference because of various reasons, such as checks and float and changes in treasury account balances at the central bank, if that creates any imbalances, the central bank's job, the RBI's job, is what they call offsetting operating factors, to add and subtract reserves on a technical level to make sure that they do a reserve add before they demand a reserve drain. In other words, to ensure that that reserve market is in balance. And so there's, at this point in time, absolutely nothing needs to be done. The idea that the debt could get so high that the private market won't finance it is an inapplicable concept. It's inapplicable to today's institutional arrangements. You'd have to change all those arrangements and make them adverse to the government for you to even conceive of having a problem. And even with all that, even if you made it a complete problem, all the legislature has to do is reverse the policy of not letting the Treasury run an overdraft in its RBI account, and then there'd be no problem whatsoever. And there isn't any reason not to allow the Treasury to have an overdraft in its RBI account, but as a matter of policy, most governments don't do it because under the gold standard, they might have lost some gold doing that, but it's completely inapplicable. And it doesn't change anything. It doesn't change inflation. It doesn't change interest rates. It doesn't change the currency. It's purely technical. It has nothing to do with any of that. Did I answer your question?
Yes. Thanks
Okay.
for that. That's very helpful to understand. I have one question for Dr. Van before we move on to the Q&A. We had Dr. C. Rangarajan, the ex-RBI governor, making a statement that yes, we will need monetization to finance the kind of expenditure that the government requires. But at the same time, we also had another ex-RBI governor, Dr. D. Subbarao, highlighting that what is really the problem that monetization is trying to solve. Because if you look at the bond yields, and even with today's inflation numbers, which are on the upside, 10-year yield is still below 6%. So, do you think, do you still feel deficit monetization is required, or can the government meet these additional expenditure requirements through additional borrowings from the public market?
So I think it's not possible to frame this question as an either or. I mean, India needs to do both because the scale of the general government borrowing, both from the union and the state governments, is fairly high, and the funding requirements are quite high. And if there is so much of debt paper coming on into the market, then 5.8% may not hold. And even now, the spread between the policy rate and the 10-year bond yield is fairly high, considering that the policy rate is close to 3.75 and the 10-year is 5.8. So this is quite high, and naturally it cascades into private sector borrowing cost as well. So I think India needs to explore all the options. It is not a question of either or. At the same time, I think too much of monetization, given the difference, as I mentioned, that financial markets apply to the treatment of emerging economies, one has to be mindful of the impact on the currency, on our inflation expectations, etc. So I think announcing not an open-ended but a very specific one-off RBI financing of the central government deficit, which is why I took a figure of $50 billion, which roughly equals 2% of GDP, roughly, GDP as of March 2019, March 2020 rather. That would help. It won't be considered too profligate or too much of excessive money supply creation, etc., etc. So I think there is a place for it, and there is also a place for market borrowing, etc. So I wouldn't consider them as mutually exclusive.
So let me just say, look, monetization would be the same as just having the Treasury sell very short bills. It's just a yield curve shift. The reason 10-year is higher than the policy rate is because there's a presumption that over time the policy rate could drift a lot higher. So it anticipates changes in the policy rate over time. So it's not because of some funding issue. And so what monetization does is changes the duration of the outstanding rupiah from whatever the duration of the public debt is to a one-day duration, which is a duration of a reserve balance. Now, does India pay interest on reserves, or does it?
It does.
Okay, so so that's a zero duration or one-day duration investment. So, and it's the same as it's functionally absolutely identical to if the Treasury just had one-day Treasury bills, or if it had floating rate Treasury bills. It'd be exactly the same thing. So it's just another way to say the same thing. It's not anything, qualitatively or functionally different. And if you think that the duration of the debt, public debt should, the money supply, let's call the public debt the money supply. It's the outstanding money supply. It's the rupee in the street. It's the net money supply in the economy. It's the net financial assets in the economy. If you think the net financial assets should have a shorter duration, fine. I think they should. I don't think they should. The Treasury should sell anything longer than maybe a 3-month bill, so you have collateral for that purpose. But I don't see any public purpose in going beyond 3 months. And then it would pretty much be identical to the policy rate. And also, I think there's a very strong case to have the policy rate permanently at zero, not anything above that. And I think that history has proven this right. you can make the statement, and the mainstream statement is that higher rates somehow fight inflation. But if you look at New Keynesian economics, and if you look at their response to modern monetary theory, they say, look, we can't run large public debt to support full employment, because if the debt gets too large and the central bank wants to raise rates to fight inflation, it won't work, because when the debt gets too large, the amount of interest the government has to pay by raising interest rates causes more inflation just through the fiscal channels. It's more spending on interest. It raises the public debt and raises inflation. And I say that's not an argument against modern monetary theory. I say you're absolutely right. Raising rates is a case of the government paying more interest. The government's a net payer of interest to the economy. When you raise rates, that's like basic income for people who already have money. You're just paying interest to everybody, on a net basis to people with money. And that is an inflationary bias. It's an expansionary bias. And I say we're already at that point. We're already at 100% debt to GDP. Probably 50% debt to GDP is more than enough. And so it's not a case of if you sustain full employment with deficit spending, you've taken away the central bank's ability to fight inflation. It's already gone. The central bank has never had that ability to fight inflation. Ever since I started 40 years ago, 50 years ago, I'm dating myself here, I've seen rate increases as causing inflation, including the Volcker period, and the high rates prolonging inflation. Let me give you one other example on finance. Okay, I use Turkey as an example. Turkey had 100% interest rates, 150% currency depreciation every year, and they had quadrillions and quadrillions of lira of deficit spending, and they never had a problem funding the debt in lira. Okay, so either Turkey was the best credit in the world or something else is going on. Okay, they were the worst credit in the world. And I remember talking to people in Mexico during the Mexican crisis in the mid-90s, the height of the crisis. I was on with the central bank, and I said, they were talking about a problem in financing, and I said, CETES? And they go, which was their short bills in pesos. They say, well, no, we can sell as many of those as we want. Okay, so this has never been a problem in any country in the history of the world, including, and it's never going to be a problem. And I can give you the reasons, but you also have every scrap of empirical data backing this up. So I'll give you the technical reasons about shifting reserves, and I give you the empirical data. It's just not a problem. And monetization and not monetization it's not anything you need to worry about or even discuss, or you should or you shouldn't do, because it's of absolutely no consequence to things.
Thanks for that, Warren. In fact, it's a useful insight for a lot of us who have been taught that it was the inflation targeting regime and the independence of the central bank post the 1980s and 1990s, which has really led to lower inflation. So we are running above our time limit, so I'll quickly get down to the Q&A session. All the attendees will see a feedback form. It would have come on your screen. We request you to please fill that up. I'll request both the speakers to be brief in their responses to these questions so that we can take the maximum from here. So I see a lot of questions, and this is for Warren. I see a lot of questions here of the flavor, MMT, what about inflation? So Warren, if you could just briefly, I think most of your talk just touch upon that. You mentioned about your theory of price, but if you'd just like to answer that so we can get a lot of the questions off the ground.
Okay, and quickly, three things. So number one, the sequence that people understand is backwards. Once you know the government's spending first, then how can you be crowding anybody out? You've just added the money you're now going to be getting, that's going to be used to buy your security. So you're just shifting it around after you've spent it. Number two, they've got the interest rate thing backwards. Raising rates causes inflation. Raising rates is basic income for people who already have money, and it actually increases aggregate demand because the economy is a net saver. The government is a net payer of interest, and it's just like increasing the allowance of the economy, increasing the income in the economy. So that's backwards. And right now, and so once you understand the government spends first, there's no solvency issue. The government's not going to go broke. It's never going to have a funding problem because it doesn't fund. It spends first. That's the funding. It just credits accounts. That's how it funds itself. The rest is mop up. Okay, taxes get paid, bonds get sold. That's mopping up what happens after the government's already spent. So you don't have to worry about it constraining spending. Okay, receipts are not a constraint on spending. The lack of borrowing ability is not a constraint on spending in your own currency. Okay, because you're spending first and then borrowing. So that it is that simple. Okay, and the mainstream economists are still like the guide in Pompeii. They go, no, 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 and they grab their head and they walk away. This is too much, the idea that the government's spending the coins first and then collecting, something everybody knew 2,000 years ago is common knowledge. And the last thing is the price level is a function of prices paid by the government. The government is price setter. Every inflation can be traced to prices paid by the government. Yes, prices can go up initially for all kinds of reasons, relative value, but if the government decides not to pay the higher prices, and I'm not saying it should do that, it might be good policy to have inflation, but if the government decides not to pay the higher prices, then government doesn't spend. And when government doesn't spend, there's not enough money out there to pay the tax, and the whole economy deflates to where the economy needs the government's money to pay the tax, so it has to offer lower and lower prices to get the money until it's got a price low enough for the government to accept it. You know, the people have to show up to work in Pompeii for whatever the government decides to pay them. They can't get enough money to pay the tax, and they're going to lose their house. And it's really that simple. So what MMT does is it gives you an understanding. There's no solvency problem. The price level, the inflation comes from the government paying higher prices, which might mean inflation is okay. Inflation doesn't lower the real wealth in your economy. It just redistributes it, which was correctly stated. I agree with that. But and the interest rate thing is backwards. And let me leave my response at that. And if you have those three takeaways, you're way ahead of the other reporters who are talking about what MMT is.
Thanks, Warren. In fact, that also addresses a lot of questions here in terms of what are the automatic stabilizers which are built in. Like you mentioned, the government can regulate the price of, not only the price of the currency, but also regulate the employment and unemployment through its fiscal policy.
Yes, because it's creating it. It's creating it, and the same forces that create it regulate.
Dr. Van, there's a question for you. It's not in the same language as the question here, but it broadly touches upon something that you talked about. You mentioned that there is a need to increase the importance of fiscal policy. We saw that fiscal policy has been waning in importance compared to the monetary policy. You also mentioned that government should operate under the principle of do you see any contradictions in that in terms of a larger role for the fiscal policy, increasing the role of the government in the economy to a level which could be harmful?
I think that point I made in the context of the developed world where monetary policy makers have taken center stage in the last 30, 40 years. In the context of India, yes, I also went through the questions quickly. Somebody said, I asked whether the government of India should be making monetary policy. That's not what I said. I said, I didn't say government of India should be setting monetary policy and not the RBI. So that question is wrong. I simply said that in general, fiscal policy has been downgraded and monetary policy has been elevated in textbooks, etc., because it is done by unelected representatives and is considered to be experts compared to elected representatives who run fiscal policy. In the Indian context, I think I simply said the deficit monetization is something which is not the case of fiscal dominance as Viral Acharya had put it. And in fact, somebody had asked this question whether Virar Acharya's criticisms are valid, and will not deficit monetization further increase the fiscal dominance? In theory, the answer is yes. In fact, fiscal deficit monetization completes the fiscal dominance in some sense, making central bank objectives secondary to the government's fiscal objectives. So in that sense, he's right. But if you want to see a very good response to Virar Acharya, you must read T.T. Ram Mohan in Business Standard today. That is an excellent article by T.T. Ram Mohan, professor at IIM Ahmedabad, on why fiscal dominance is not a conspiracy on the part of the government to make a central bank look less effective, and it is not something that will endanger financial stability too much. So that is my response to that is please check out T.T. Ram Mohan. And what was the other question?
Can I give a quick response to that question?
Yes, sure.
To add something? Okay, so the MMT position, or my position, is that monetary policy doesn't work, and it's never worked. And so it's always been fiscal policy that has made the difference, whether anybody knows it or not. So we're not advocating a shift from monetary to fiscal. We're just saying monetary's never worked. The question's moot. Okay, all we have is fiscal, and the sooner we recognize that, the better. Okay, so it's not, a lot of people say exactly what's been going on. What they say is MMT is advocating the shift. It's not a shift. It's never been there. Monetary policy is like the child in the car seat with the steering wheel that's not connected to anything. And everybody thinks he's been driving. And we say, no, the driver is behind the regular steering wheel. That's the legislature. And you say, well, you want to shift policy from this driver? No, we're not shifting it. He's always been in the driver's seat. Thank you.
Thanks for that. I think we'll have to wrap up today's session. We are through with the buffer time as well.
Ravi, somebody asked me what is the name of the book I mentioned. I mentioned the book, The Fourth Turning. The Fourth Turning.
Thank you. Thanks for that.
Okay. Yeah.
And maybe we can just take one last question. I saw on this list a lot of people interested in learning more about MMT. Dr. Mosler, one reference you would recommend to the attendees if they want to learn more about modern monetary theory?
So I have a book, and it's free. It's online, and it's called The 7 Deadly Innocent Frauds of Economic Policy. And you can go to my website, which is moslereconomics.com. And it's under mandatory readings. And you can click on it and download it and read it. It'll take you less than an hour, probably.
Great. Thank you so much, everyone, for joining. Thank you so much, Dr. Van, for accommodating this request. It's very late where you are. Thank you so much. Really appreciate it. Thank you so much, Warren. You were very gracious to accept this invite. We reached out to you pretty cold, and you did accept the invite. We're glad that you could do this talk. And it's very early, I think, where you are. So thanks to both the speakers for accommodating today's session. Thanks to all the attendees, for all your questions. We shared the link for the presentation, so we hope you find it useful. Thanks everyone. It was great, doing this webinar. Thank you. Signing off.
Thanks very much.
Good day. Bye.
Thank you.